Hello, this is John Piper, and I'm going to talk in this clip on option trading on the currency markets. You'll see my open positions on IG index, and the key things here to look at are I'm going to talk about my September strategy on the pound dollar. So you'll see I'll sell 2 lots of 10 here. This is a fairly relaxed strategy. It's an easy one to manage, and it's easy to talk about. And the sales prices were 308 for the 1440 puts and 270 for the 1560 calls. Okay, there's quite a few points to make on this. Firstly, I do various options, either the quarterly options, so June, September, December, March. It's all a matter of price, really. I just try and find the right price. In the case of September, I can go quite a long way out, get reasonable premium. If you add the puts and calls together, the 308 and the 270, I've got just short of 580 for that strangle, and that means that the market, pound dollar in this case, can go 5 cents or 5.8 cents below $1.44 or above $1.56 before I'd lose on the position. Now, of course, September's a fair way away. The market can do quite a lot in that time, but that's quite a lot of cover, really. It means that I've got I can relax on the position. I mean, since I opened the position a few weeks ago, the pound has rallied against the dollar, so the puts are in profit. So they're now down at 230 with a profit of about 700 quid on that. But of course the calls have gone against me, so they're now £400. So currently 400 points. So currently I'm losing on the strategy, but only by a bit. In fact, that virtually always happens. I mean, any move you get, you tend to see a bigger increase on the one you're losing on, and a smaller increase on the one you're winning on, so decrease. So you tend to be in a loss, but then as the time value comes out, that changes round. I think the other key point is the expiry date, 15th September, third Friday in September. At least that's how it ought to be. And at that point, the thing expires, and all the time value vanishes. Currently, the prices are entirely time value because the options are out of the money. An option price has two components: intrinsic value, which is the amount is in the money, and time value, which is the difference between the intrinsic value and the price. As the option is out of the money, there is no intrinsic value. Just an example, the 15600 call will only be in the money when pound dollar is above $1.56. Currently is about $1.53, so it's a fair way away from that. The final point I should make here, I guess, is that IG quotes these as a 15,600 call, and that's 15,600 basis points. So £10 a point is actually quite a big position, in that that's £1,000 a percent. So, sorry, percent, not percent. You see what I mean? So it's £1,000 for every cent, and that means that at 150, the position is £150,000. Sorry, $150,000 dollars worth. No, £150,000 worth, because it's £10 a point. If it was $10 a point, it'd be $150,000. Anyway, so it's not a small position. And here to watch this with currencies, it can be quite confusing. You go in at £10 a point, then you find suddenly you've got a huge position, which you want to be careful. You always start small on any strategy. Paper trade first, if possible. This is a strategy which I'm not going to actually recommend to anybody, because you either want to do it or you don't. It's not something I'd ever sell to anybody, because options can be dangerous. It's something that, if you're interested in trading the strategy, then you need to put some work in. You've got to think about it carefully. The biggest problem is you've got to hedge. Anyway, let's look at a chart of the pound dollar, and then we can explore the strategy in a bit more detail. Okay, here's the chart of the pound dollar, and let me add a few things here. Now, I took this position on about 3 weeks ago, I think, about here. So we sold the 156s, which are around here, and the 1440s, which are down here somewhere, going off the chart, in fact. As I said, I got a total price for the two options, puts and the calls, at around 580. So what this means is that the neither option will be worth any money at all unless it goes above either there or below here. So if the pound dollar stays in that range until September, which is probably unlikely, then the whole 580 at £10 a point, which is what, £6 grand, will be a winning trade. What's more likely is that we're going to see the market go either up or down. It may spike. It doesn't make a difference. I mean, the key thing from the trader's point of view is you have to decide whether or not you want to take any action if you see the market go beyond your parameters. So the first thing to do is calculate the point at which you actually go into a loss situation. So we got 580 for the options. The strike is 156. So you add 580 to 156, and we get 16180. So we're actually covered up to around here. Okay, so there's no actual market can get up to 16180, and we'd still make money. It wouldn't make as much money as if it stays in the range, this range here, but we're still covered up to here. Okay, so that's quite a big range, really. Think about it. 1440, you cover down to 138, up to 161. That's you know, a good 20 cents plus. So you might say, well, I think that's a fair range. I'll just sit on it, and over time it'll come good. And it's you know, if you test the strategy back, which you ought to do, you'll find that often you will do very well. But there will be the occasions when a sharp move could cost you very dear. So it's quite important to be aware of that. You know, if you're just using a strategy of hedging your pounds, so you just sell calls against your sterling holding because you're worried about the value of sterling falling, then you're actually covered by the value of your sterling. If you just sell the calls, i.e. these calls here, imaginary calls you like, then the pound can shoot up, and yes, you lose on the calls, but you make the same money back on your sterling. So you'd end up in the same position in effect, although you had to give IG Index or whichever betting company you use a check to cover that. However, what I tend to do myself is I start to hedge. So with this kind of cover, you've got quite a lot of scope for hedging. We've got 6 cents here, £10 a point. So I would tend to buy a couple of spread betting contracts on the pound dollar, £2 a point, every cent, which is a fairly relaxed stance. I'd use a stop of 1 cent. So on that basis, every time I hedge, I'd lose £200. So it becomes a war of attrition, which I explained in the way to trade. Now, again, I'm not going to go into huge detail. First thing, I want to keep this clip to a reasonable length. Secondly, I wouldn't want you to do this unless you fully understood it. So I don't really want to fully explain it because I'd rather you worked it out for yourself. If that makes some kind of sense. It's not something that you should just take lightly. So I'm just going to cover this fairly briefly. If it's something that you are interested in, then you must explore it more fully yourself. Because option trading is probably the most dangerous form of trading that there is, and I've experienced it over many years, so I know exactly what I'm talking about on this particular point. But basically, if you're hedging on this basis, you're risking, say, £200 every time you hedge. Your stop's 100 points away. You got £6,000 in hand, so you can hedge 30 times and lose 30 times. And you'll still come out on top at the end of the day. But if you had to hedge 31 times, 32 times, of course that's a bit different. So it just depends how the market behaves during the course of this period, as to how you end up doing. Now you can adapt your hedging strategy. You could, for example, decide to move stops up. If you take a hedge, market moves further, you take another hedge. Market moves further again, take another hedge, then they can stop you moving your stop, so they're actually locking in profits on each of the hedges you're doing, except for the last one, of course, because that won't go so well, probably. So the right way of doing this, but the basic point I want to make is that if you adopt this form of trading, then you can get a very attractive position on paper, whereby you've got a fairly large sum of cash in hand. Your hedging strategy can be fairly relaxed, and And of course the only question is what can go wrong. Well, pound dollar and all currencies are 24-hour markets, they trade all the time. So you may see sudden moves while you're asleep, which is, I mean, you can put stops in IG, that does help. So in fact it wouldn't matter if you saw a straight line move, because you just put your stops in place to enter your hedging positions, and as long as the market just keeps going up, you're okay. If it starts jerking around, goes shooting up, then goes shooting down again you're okay, because you've got your stop in place to take you out of your hedge. But these things can become very uncomfortable, so it's something to do very low key to start with. I would suggest you go in at a pound a point. Just something very gentle. Even a pound a point is 15,000 pounds worth of position. But even so, it's fairly relaxed. You can hedge in 0.2 of a point 5 times. It'd be a good way of trying it out without being under any huge pressure. Okay, that's really all I want to say about this strategy. And if you want to know more, then please get in touch. And thank you for listening. Goodbye.